All right, let's dive right into this explainer. Today, we're completely peeling back the curtain on the asset management industry, and we'll be using Ed Moison's seriously eye-opening book, The Economics of Fund Management, as our guide. Now, you know how it is. When people talk about investing, they usually get totally caught up in the technical stuff, right? Like what stocks to pick, how the pros invest, all those hot market tips. But today, we're taking a completely different approach. We are going to look at this sector purely through the lens of a business model. We want to break down exactly how these financial giants actually operate behind the scenes, and most importantly, how they generate their absolutely incredible revenues.
To really grasp the stakes here, I want you to consider this staggering number, $100 trillion. That is a 1 with 14 zeros. Globally, this industry, which honestly is pretty poorly understood by most folks, controls over $100 trillion of financial assets. It's a number so huge it's almost impossible to wrap our heads around. Yet, despite managing this massive chunk of the world's wealth, the inner workings of these firms remain a total mystery to the average person. They are literally the engines of global finance, and today, we're popping the hood to see how they work.
So to demystify these financial giants, we're basically going to follow the money. Here's our roadmap. We'll start with the $100 trillion industry, then look at generating revenue through fees, move right into the cost of doing business, tackle navigating conflicts of interest, and wrap up with the evolving future.
Okay, Section 1, the $100 trillion industry. We're starting right at the top with the sheer scale of a sector that, despite its massive size, stays almost completely opaque to the everyday investor. When an industry is this large, understanding its foundation is step one to knowing where your money actually goes.
Before we get too deep into the weeds, you got to remember one crucial point. Behind all that dense, complex financial jargon, these are really just businesses selling a product. If you strip away the mystique of Wall Street, an asset management firm is just a company that pulls together capital from clients, which could be everyday people like you and me or massive pension funds, and invests it on their behalf. They aren't some sort of magical money-making entities. They have organizational structures, aggressive sales teams, overhead, and profit margins to hit, just like a tech startup or your local retail chain.
And, well, this brilliantly illustrates exactly why understanding their business model is so absolutely vital. Because when investors are kept in the dark, scandals happen. As Ed Moison points out, the financial crisis brought intense scrutiny to this sector, and yet investment scandals just continue to dominate the financial headlines. Why is that? Because the actual mechanics of how these firms operate and make their money are not widely understood by the very people handing over their life savings. If you don't know how the business works, you simply don't know where the risks truly lie.
Moving right along to Section 2, generating revenue through fees. This is the absolute core of Moison's analysis, and it's what we really want to drill down on today. How fund management firms actually earn their keep.
I mean, if you've ever put money into a mutual fund, an ETF, or even just a standard retirement account, you really need to ask yourself this one critical question. How do they actually make their money? We all know they manage the cash, but how do they extract value for themselves? What exactly is the price tag for their expertise, and how is it being collected from your account?
Moison's book breaks this down just beautifully. Basically, they siphon off revenue through specific fund types. These incredibly persistent management fees, and a whole slew of additional operational charges. This right here is the absolute lifeblood of the asset management business model. They aren't generally making their money by just taking a cut of your profits, right? No, they generate steady, super reliable revenue by charging management fees based on the total volume of assets they hold. Whether the market goes up or crashes down, that percentage fee is locked in and persists. On top of that, there are all these additional charges just quietly embedded in various fund structures. It is entirely a volume game. The more money they hold, the more they earn, through this really intricate charging system.
As one reader, Wiseby, pointed out in a review of the book, these fees literally power a massive machine of underlying functions. You know, it's not just about paying some guy in a tailored suit to pick stocks for you. The revenues generated by those fees fund these massive sales and product development departments that are designed to do one thing: attract even more capital. They fund the actual money management, yes, and the highly paid fund managers. But critically, they fund the vast legal and compliance teams required to navigate mind-numbingly complex regulations across the US, the UK, and Europe. This is a massive, highly structured corporate operation entirely funded by the charges applied to your assets.
All right, Section 3, the cost of doing business. Because hey, it's definitely not all pure profit. Let's actually explore what eats into those massive revenues. Because just like any other corporation, asset managers face significant, evolving cost pressures.
So, a major cost pressure today, and Monson really highlights this, is the increasingly strict requirement for firms to integrate non-financial considerations into their incredibly complex investment processes. We aren't just talking about glancing at a balance sheet anymore. Firms are increasingly required both by regulators and by client demand to consider environmental, social, and governance factors. Actually building the infrastructure to analyze all those non-financial data points requires immense resources, brand new technology, and highly specialized staff. And all of that, it squeezes their profit margins.
Now, what's really fascinating here is how they actually divide up their overhead. It's this delicate, high-stakes balancing act. They have to pay an absolute premium to retain star investors. You know, those high-profile fund managers whose reputations alone can attract billions in client capital. But equally large slices of their budget go toward maintaining complex client relationships and just trying to keep up with an ever-growing mountain of global compliance and regulation. At the end of the day, the business of managing money is surprisingly expensive.
Which brings us to Section 4, Navigating Conflicts of Interest. Honestly, this is kind of the dramatic peak of our explainer today. Because once you understand how they earn and what they spend, this massive structural conflict suddenly emerges. The central conflict of this entire industry boils down to this constant built-in tension, maximizing returns for you, the client, versus maximizing fee profits for their own shareholders. Think about it. A firm earns way more by keeping their own internal costs low and their fees high, which is great for the firm's shareholders. But as a client, you want the exact opposite. You want the lowest possible fees and the highest possible investment in resources that actually generate returns for your portfolio. These two goals are just fundamentally at odds. Morrison's book shines a really bright light on how asset managers constantly have to walk this tightrope, trying to keep both groups happy while their financial incentives pull them in completely opposite directions.
Finally, Section 5, the evolving future. Let's take a look at where this $100 trillion machine is actually heading next. The industry is vast, sure, but it is certainly not static. Moissan concludes that the sector's future depends heavily on three key steps. Step 1, navigating this absolute barrage of evolving regulations designed to protect investors. Step 2, figuring out if it can overcome the areas where it is just stubbornly struggling to change, specifically updating incredibly clunky legacy systems and adapting a very traditional business model to modern demands. And Step 3, redefining the nature of its client relationships in an era where, quite frankly, transparency is increasingly demanded.
As reviewers like WiseBee highlight, finally seeing this massive industry simply as a business gives everyday people, us, a comprehensive understanding of where our fees actually go. You really don't need to get bogged down in the technical details of complex investment algorithms to understand the economics of the firm holding your retirement account. By understanding their organization, their sales strategies, and their charging systems, you become a far more empowered participant in the whole financial system.
So, I'm going to leave you with this one provocative thought today. As the industry inevitably evolves and faces mounting pressure to be transparent about its fees and operations, who will ultimately benefit from your investments? Will it finally be you, the client, or will the firm's shareholders always win out? Understanding the economics of fund management is the very first step in making absolutely sure your money is truly working for you. Thanks so much for joining me on this explainer, and I highly encourage you to keep questioning the business behind your investments.